Today I'll be going over what a price to earning ratio or PE ratio is, so let's get to it. The P/E ratio, or price to earnings ratio, is a measure of how much investors are willing to pay for a company's earnings. It is calculated by dividing the current stock price by the earnings per share, EPS. A higher price to earnings ratio means that investors are paying more for each unit of earnings, which could indicate that the stock is overvalued or that investors expect high growth rates in the future. A lower price to earnings ratio means that investors are paying less for each unit of earnings, which could indicate that the stock is undervalued or that investors expect low growth rates in the future. There is no definitive answer to what is a good price to earnings ratio, as different industries and sectors may have different average price to earnings ratios. However, some general guidelines are: a price to earnings ratio of 15 to 20 is considered average or fair value for most companies. A price to earnings ratio below 15 is considered cheap or undervalued, but it could also mean that the company has low growth prospects or faces some challenges. A price to earnings ratio above 20 is considered expensive or overvalued, but it could also mean that the company has high growth prospects or competitive advantage. One way to determine if a price to earnings ratio is good or not is to compare it with the price to earning ratios of similar companies in the same industry or sector, or with the price to earning ratio of the broader market, such as the S&P 500. For example, as of October 26, 2021, the price to earnings ratio of the S&P 500 was 28.611, which means that the average stock in the index was trading at 28.61 times its earnings. If a company has a price to earnings ratio significantly higher or lower than the market average, it may indicate that it is overvalued or undervalued relative to its peers. Another way to determine if the price to earning ratio is good or not is to use different types of price to earning ratios, such as the trailing price to earning ratio, the forward price to earning ratio, or the PEG ratio. The trailing price to earning ratio uses the earnings from the past 12 months, which reflects the actual performance of the company. The forward price to earnings ratio uses the projected earnings for the next 12 months, which reflects the expected performance of the company. The PEG ratio divides the price to earnings ratio by the annual growth rate of the earnings, which adjusts the price to earning ratio for the growth potential of the company. These different types of price to earning ratios can provide more insights into the valuation and prospects of a company. Remember, investing decisions should not be based solely on price to earning ratios. It is always a good idea to consider other financial metrics and factors as well. If you need help with price to earning ratios to invest your money, consider working with a financial advisor. Thank you for watching.